Okay, so let's get started. Okay, so this quiz of the three is probably the most self-contained because it's just capital structure. Okay. That said, there are elements of previous quizzes that will come up, right? Like Ghosts of Christmases Past, levered betas, things that you thought you'd left behind you. So these are the four basic things that I would like you to be able to do in the quiz, and the quiz I'm going to try to write to see if you can do them. The first is the trade-off we talked about between debt and equity, the qualitative trade-off, tax benefits, added discipline. So I might frame a question around that trade-off, and that question is going to be, if there's any question, it's going to be more qualitative than quantitative, multiple choice question, if it does come. The second is, can you estimate the optimal debt ratio? This is something you're wrestling with on your project. It should be able, you should be able to do it. Whether you use a cost of capital approach, an adjusted present value approach, or looking at other companies in the sector, whether you can come up with the optimal debt ratio and what the effect on your value would be from moving to that optimal. Third is based on the company's fundamentals. I need you to tell me whether you should move quickly or gradually, whether you should take projects or buy back stock. And finally, can you use those macroeconomic regressions we ran to tell me what the right kind of debt for your company is. So let's start with the trade-off, right? Two big benefits of debt. Tax benefit that comes from the fact that interest is tax deductible and cash flows to equity generally are not, and the fact that debt can make you more disciplined as a company. Disciplined in what sense? Managers who are sloppy about taking projects might become less sloppy if their jobs are on the line. By borrowing money, you force them to think about consequences. Okay? So think the Volvo example. On the other side of the equation, you got expected bankruptcy costs. When you borrow money, I don't care who you are, you could be ExxonMobil, your chances of defaulting increase relative to before you borrowed the money. So it's not even across companies, it's for the same company. More debt is going to make them more risky than less debt. The second is when you borrow money, you create this conflict of interest between what's good for stockholders and what's good for bondholders, and it plays out as covenants and restrictions and legal oversight and all those costs. And finally, every time you borrow money, you give up some future flexibility. So let's try a few multiple choice variants here. And I'm not going to state them as multiple choice, but you can kind of see them framed as such. I mean, right now, if you look at the presidential campaign, everybody's talking about changing corporate tax law. Everybody seems to agree that it's a mess. And one common theme that seems to cut across all the campaigns is that the tax rate on corporations at 40% is indefensible, partly because of the global competition, money moves out of the US. So almost everybody's talking about reducing taxes. Nobody's talking about deducting dividends, but let's assume that one of the presidential hopefuls says, you know what, the problem here is we allow companies to deduct interest for tax purposes, but we don't let them deduct dividends, so we should allow them to deduct dividends. Let's say that's actually a proposal on the table, that companies will be allowed to deduct dividends to get to taxable income. What effect will that have on debt ratios? Increase, decrease, leave unchanged? The trade-off, what's changed? The tax benefit of debt stays the same, but I've created a tax benefit for equity, and at the margin, if I create enough of a tax benefit for equity, the extra tax benefit of debt could disappear. This is actually a variant of what Brazil has with its interest on capital. It gives a tax reduction to equity. By doing so, it makes a tax benefit. So when you think about the tax benefits of debt, it's not just the tax benefit of debt, but what it is relative to equity that drives borrowing. Here's the second one. There's a lot of talk about companies borrowing way too much money, that maybe they're taking advantage of that interest tax deduction. So let's assume that one of these proposals, and there are a few countries which have this, there's a cap on how much you can deduct for interest expenses. Right now the cap is if you have the taxable income, you can deduct up to the taxable income, but let's assume the law says you cannot deduct more than 50% of taxable income in interest expenses. Again, the effect is going to be, I'm reducing the tax benefit of debt. You're going to therefore borrow less money than you did before, simply because you're not going to get the full tax benefits once you get past 50%. In fact, start thinking about how your cost of capital computation would be affected if I put in a 50% cap. What would you need to do? Up to 50%, you get the full tax benefit, 40%, but then beyond that, you get no tax benefit. Just as I adjust your tax rate for interest expenses exceeding your taxable income, I'd have to adjust your tax rate for interest expenses exceeding half your taxable income, or whatever the cap is. So it's going to show up as higher cost of capital for high debt ratios and essentially keep you away from those debt ratios. So look at the trade-off, understand the things, and ask some what-if questions. Take something in the news, look at it and say, what effect will this have on debt ratios? Because almost everything you see in the news has implications for how much a company can borrow. So let's talk about specifics. The tool that we use, yes, go ahead. Yeah.
So you're saying that when the companies are borrowing less, then that would have an overall decrease in firm value?
Now you got the cause and the effect mixed up. They're borrowing less because there's less of a tax benefit to debt. Now, if you borrow less, then you obviously get less of a tax subsidy from debt, which means that the firm value of highly levered firms will be lower than it was before the tax law passed. So, but the cause effect is, the cause is the tax law, the effect is what you see as debt. Any other questions on the trade-off? So the tool we used predominantly to come up with the optimal debt ratio is the cost of capital. At the risk of reviewing something you should all have nailed down, let me very quickly go through the inputs into the cost of capital. There's a cost of equity. The cost of equity is the risk that marginal investors see in this company, and because we assume they diversify, we measure the risk with a beta and we come up with the cost of equity. Embedded in there is your choice of a currency, the risk-free rate, and where the country or company operates in the equity risk premium. So that's the cost of equity. The cost of debt is the rate at which you can borrow money long-term today. Remember that. It's not the rate at which you borrowed money 2 years ago, 5 years ago, 10 years ago. The rate at which you can borrow money long-term today. Net of the tax benefit you get from the debt, and that's where you got to check and make sure you can get the tax benefit. The weights are supposed to be market value weights. Market value of equity is usually easy, but sometimes I might give you book debt, you might have to convert to market debt. Those are the inputs into the cost of capital. Now, if you think about the cost of capital then, the inputs are all the same inputs we used when we did investment analysis. The only difference here is we're using it not to figure out a hurdle rate, but to decide what the right mix of debt and equity is for a company. So let me take an example. This was from way back. And this is really an example about the mechanics of cost of capital. So as I go through, if any of the mechanics are still hanging loose, let's make sure we tie them up. So this is a company, and you're asked to compute the cost of capital. It has 15 million shares outstanding, trading at $10 per share. So market value of equity is about 150 million. I also give you the book value of equity. That's actually not redundant information. There's another part of this problem where you will be asked, where you need the book value, but you have both the market value of equity and the book value of equity. Now comes the interesting part. There are three types of debt. The first is a $50 million bond offering that they've made with a coupon rate of 7%. And the three most important words in this quiz were trading at par. We'll come back and talk about why trading at par. The second is that the firm has an old bank loan on its books. Keyword is old, right? So when it's an old bank loan, what you observe is the interest rate on that loan has nothing to do with the cost of debt today. The interest rate on that loan is 8%. It has 5 years left to maturity and a face value of 50 million. And the company also has lease commitments of 10 million every year for the next 7 years. So it's a corporate bond, a bank loan, lease commitments. Whenever you have to compute cost of capital, somewhere in the problem I have to give you a current cost of borrowing, right? There are three ways I can give you the current cost of borrowing. One is I can give you a rating and a default spread, and we add the default spread to the risk-free rate, you can come up with the cost of borrowing. The second is I can give you operating income and interest expenses, but then I have to give you a lookup table where you can look up the interest coverage ratio and come up with the rating. That's a little messy, and I usually don't, but I could do that. And the third is I can slip in some information from the market today that you can use to come up with the cost of debt that doesn't need a rating and doesn't need a default spread. In this case, this problem, now do you see why the trading at par is so critical? When does a bond trade at par? What does it be true about the interest rate on the bond today, Greg? The interest rate has to be equal to the coupon rate. In fact, the biggest struggle people had with this problem is they kept looking for a rating and a default spread. They couldn't find it because every problem they had seen a rating, You don't need a rating. You need a current cost of borrowing. You have that on this bond. That becomes the pre-tax cost of debt. You're saying, what about the 8%? It doesn't matter. That's an old interest rate. It has no relevance to cost of debt. You can't average the 7 and the 8 and say the cost of debt is somewhere in between. It's not. That's the old rate at which you borrowed. The cost of debt in this problem is 7%. The firm's current beta is 1.2. And remember what I said about in the first quiz still applies. If I say beta, it's always a levered beta. If I want to give you an unlevered beta, I would very specifically say the unlevered beta is. So in this case, that's a levered beta. The T-bond rate is 6%. The market risk premium is 5.5%. The firm reported earnings before interest and taxes of $40 million. And because it's computed with conventional accounting, that's after operating lease expenses, because operating lease expenses are treated as an operating expense, and as a marginal tax rate of 40%. Ready? Let's try this out. First, I want to compute a market value for the debt, because that's the messiest part of this problem. To get a market value for the debt, I'm going to start with the cost of debt, which is 7%. The bank loan rate doesn't matter. The lease commitments don't matter. I have the 7% cost of debt. I have 3 different debt issues to estimate market value for. Let me start with the easiest one. The value of the corporate bond is $50 million. Why? It's trading at par. That's the book value. That's the market value. So that was easy. The bank loan has 5 years left on it and an 8% coupon rate. The market value of this bank loan has to be computed now, because interest rates have changed from 8 to 7. So here's what I did. I took 8% of 50 million, which is 4 million. You're saying, but bonds, debt is supposed to. If you want to play with semi-annual payments, fine, go ahead. It doesn't matter to me. Right? In this case, the answers are going to be close enough that, so I'm okay with annual convention. So I'm treating a $4 million interest expense each year, and then a $50 million face value, but I discount them all back at a 7% rate. Is everybody clear on why I'm doing that? Because as the bank loan has aged, the interest rates have dropped off. The market value that I get for the bank loan is about $52.05 million. When you compute these market value of debt calculations, there's a very simple test you can run to make sure you haven't gone off the tracks. Check your market value against your book value. Okay? Then check your interest rate against the book interest rate, the market interest rate against the book interest rate. In this case, the market interest rate is 7%, the book interest rate is 8%. Whenever the book interest rate is greater than the market interest rate, the market value of debt will be higher than the book value. You can twist this around as much as you want, but that's always going to be true. When the market interest rate is equal to the book interest rate, it's going to be like the bond. Book value is equal to market value. And when the market interest rate is lower than the book interest rate, the debt is going to be trading at a discount on book value. In fact, if you're in a hurry, I'll give you a shortcut you can use so you don't have to do the present value of the bond. Do this only if you're in a hurry. You lose half a point for doing it, but it's better than not getting points at all. If you look at the book interest rate, it was 8%, right? Market interest rate was 7%. You divide 8 by 7, you get what, 1.14 or something? So basically, take the book interest rate, divide by the market interest rate, and multiply it by your book value of debt. You will get a market value of debt. That's at least in the right direction. It won't be 52, it'll be 54 instead of 52. But if you're in a hurry, at least you'll have a number to work with to get a market value for the debt. Any questions on the market value of the bank loan? Final piece of the debt, I have the $10 million in commitments for the next 7 years. Please don't write out 7 different $10 million values. I saw this in the last quiz. People are still writing out. It really is an incredible waste of time. So even if you have a scientific calculator, just work with the annuity equation. Trust me, it works. So even if you mistrust it deeply, just try it out a few times and make sure you're okay with it. Present value of $10 million at the pre-tax cost of debt is $53.89 million. I add those 3 debt issues up. The market value of debt in this company is $156 million. So bonds are trading at par. The bank loans are, I'm estimating, would trade at above par, and the present value of the loans basically is already at today's value. Sum of the 3 is the market value of the debt. Okay? Almost every problem, it's going to be either all 3, 2 out of the 3, or maybe just 1 out of the 3. I mean, there are no other debt issues you're going to see. So that's why I use this problem, because it brings together all 3. I'll open a door, but then I'll shut it very quickly. In this case, what did I give you that gave you the market interest rate? What are the 3 words? trading at par, right? What if I told you the bonds were trading at 10% above par? What would you need to do then? Well, if they're trading at above par, what does it tell you about the market interest rate? Is it lower than 7% or less or higher than 7%? Market value is higher than the face value. It's trading at 10% above par, means the market interest rate is lower than the book interest rate. How much lower? If you really wanted to do this right, you'd have to do a yield to maturity on the bond, and I'm not going to test you on that proposition. That's why I'm going to assume you know it. So between us, we'll act like we know this. It's actually, there should be some law that says you cannot get an MBA unless you can compute the yield to maturity on a bond, but I don't think that law has been passed yet. So between us, we'll act like you know it. But the yield to maturity on the bond is what you would need to do if I gave you the price of the bond and the coupon and the face value. Right? In this case, trading at par made your life easy because the market interest rate is equal to the book interest rate. Any other questions? So let's talk about what the debt ratio for the company is. The market value of equity is easy. Share price times number of shares. Market value of debt is 155.94. The debt ratio for the company is about 51%. The market equity ratio is about 49%. And the cost of capital is a weighted average. The cost of equity is 12.6%. That came from the beta that was given. Times 49%. 7% is the pre-tax cost of debt times 1 minus the tax rate. Before you do the 1 minus tax rate, though, what do you need to check? You need to check that the interest expenses you have are less than the 40 million. In this case, they happen to be. They're well below the 40 million, you're okay. But let's say the interest expenses, and this is just a what if, it's not for this problem. This problem, because I have enough income to cover the interest expenses, I get the entire 40% tax rate. But let's say the interest expenses, I think in one of the quizzes, was 48 million, and you had only 40 million in operating income. Tell me in purely intuitive terms, what happens now? The 48 million is your interest expense, right? But you have only 40 million in taxable income. So the most you're going to be able to deduct is 40 million. Your tax benefits will then be 40% of 40 million, which is 16 million, and it's capped. That's it, you're done. Your interest expenses keep going up, but there are no more tax savings you're going to get. Your 16 million in tax savings gets frozen once you get to 40 million. So if you actually have 48 million in interest expenses and 16 million in tax savings, effectively you're getting only a 33.33% tax rate, the 16 divided by 48. So just check before you put that in 1 minus t, if there's information in the problem to see if the interest expenses are less than the taxable income. Yeah.
So should that ceiling be earnings before taxes but after interest?
No, it'll be earnings before interest and taxes. There's no point taking out interest and then seeing the ceiling with interest expenses. It's earnings before interest and taxes have to be greater than the interest expense. Okay? Yes? Well, first, technically there is no interest, right, because you don't pay a coupon, but what the accountants let you do is they take the fact that you issued it below par and you can amortize it over time. It's a complete mess, to be quite honest. You know? So you'd have to understand the amortization of bonds. I'm not even going to open that Pandora's box, so no, I would let it go. Yes?
The reduced tax rate, are you using it for the beta as well as the after tax?
Yes. And actually, that's a good point. When I do the levered beta, remember there's a 1 minus t in there. So if I lose tax benefits on debt, I will lose it not just on the cost of debt, but also in that levered beta calculation. So my beta will actually increase because I don't get the full tax benefits from debt. So it's a double layered impact. Okay? And actually, that's why if you don't have taxable income, you have zero EBIT or negative EBIT, the cost of capital actually becomes very simple, right? It's a pre-tax cost of debt times a debt ratio. Your levered beta is computed using a zero tax rate. And I know a couple of people over the weekend emailed me and said, what about the fact that you can carry these losses forward and claim those tax benefits in the future? Hey, this isn't a one-time deal to compute the cost of capital. You compute the cost of capital in year 3 with the tax benefit. I'm not going to stop you, but for right now, Your cost of capital has to be computed in the world you live in, not the world you wished you lived in. And in the world you live in, you don't get tax benefits. So that's why you have to think of this almost on a year-by-year basis. And if you don't have the tax benefits, you need to take those tax benefits out of your cost of capital. Any other questions on cost of capital? Now, the other part of this problem did ask for a return on capital, and I'm going to very quickly go through this simply because this is something you did do on your company when you looked at does it have good projects. Now, I want to talk a little bit about mechanics. This is the only place, absolute only place in finance where we use book values. Book value of equity, book value of debt, because invested capital is a book value number. So usually the measure of return on capital is after-tax operating income divided by book value of invested capital. So let's see what that number looks like. Okay? My operating income, if I forget all about the leases, right? I work just with the traditional accounting statements, is 40 million. It's after taxes, so I'm going to multiply by 1 minus the tax rate. And in the denominator are 350s. You're saying, what the heck are those 350s? The first 50 is your book value of equity. The second 50 is your book value of your bank loan. The third 50 is the book value of your corporate bond. Just pure coincidence in this problem, they're all 50s. So you divide the after-tax operating income by the return on by that invested capital. The return on capital you get is 16%. Now, what do? We compare that return on capital to the cost of capital on the previous page, right? There's one small problem that when I computed cost of capital, I did capitalize leases and say they were really debt. And it's inconsistent for me to do that in the cost of capital and then compute return on capital using just the accounting numbers. So if you want to do this right, here's what you need to do. You need to correct the fact that your operating income was computed with operating leases treated as operating expenses. So here's the right way to do it. You add back the operating lease expense. See this 10 million? You add that back saying I should never have subtracted out, it's not an operating expense. And then to complete the process, you'd have to take that operating, the present value of the leases, which we got 53.89, and compute what you'd have had as depreciation this year. It's a pain in the neck, but you got to do it. And what that gives you, 42.3 million, is the adjusted operating income. The operating income adjusted for the fact that you've decided to treat leases as debt. I'll give you a shortcut that I'm willing to accept on the quiz. You got 40 million as your unadjusted operating income, right? You got 53.89 million as what you've now converted as debt for the leases. And if that had really been debt, you could have just said, look, I'd have had a 7% interest rate on that debt. The interest expense on that debt would have been 7% times 53.89. You add that to the 40 million, you get an operating income that is also adjusted for leases being treated as debt. So what that does is it pushes up your operating income, but then when you go to the denominator, you have to add the present value of leases as if they were debt. So what you see in the denominator now is a 53.89. So both your numerator and your denominator will get adjusted when you decide to capitalize leases. Okay? So this is something that is less for this quiz and more for the project, because that's something that you're doing in your project is converting leases to debt, and everything gets adjusted for it, and that's the adjustment that's happening in the background. So let's now talk about optimizing capital structure. The key thing to remember is when you change the debt ratio, everything changes. Your cost of equity will change, your cost of debt will change, even your tax rate might change. Let's take each piece. How do we compute cost of equity? We take risk-free rate plus beta times equity risk premium, right? When you change your debt ratio, your beta will go up. So whenever your debt ratio changes, you have to revisit your beta calculation. You can't leave it frozen at what it was before. Your cost of debt will change because lenders are not stupid. You go and double your debt, they see more default risk in you. When they see more default risk, they'll attach a higher cost of debt to you. The cost of debt will change. Your tax rate might change because as you borrow money, interest expense goes up. And if the interest expense exceeds your taxable income, your tax rate could change. And we did this in class for Disney. I did a couple of debt ratios. In one of the quizzes, I actually tried to make you do that. And obviously, I can't make you do that for 0 to 90% for one specific debt ratio. So I'll go to that problem. And in that problem, here's what you're going to see me do. I'm going to first compute the cost of equity at the new debt ratio. And then at the new debt ratio, I'm going to compute the cost of debt by starting with the new dollar debt I have, coming up with an interest expense at that debt, using that interest expense to come up with a coverage ratio, using the coverage ratio to come up with a rating. So let's try this. This is, as I said, from one of the quizzes. So basically what you were given was just the first column. So the second and the third columns were blank in the quiz. So if it looks too easy, it's because I've given away the answer. So in the actual quiz, all you had was the first column for 10%, and you were asked to compute the cost of capital at a 20% debt ratio. And I did list the extra column, just to remind you that you might not be done after you do it the first time around. So let's work through the numbers. First, the dollar debt at a 10% debt ratio is $1,500. I actually wrote this problem so that you could actually do it without a calculator, because most of the numbers either doubled or halved, so you can see that you can actually very quickly go through the table. So you have 1,500 million as debt at 10%. At a 20% debt ratio, that's going to become 3 billion. So I just doubled it. The EBIT stays the same. Somebody remind me again why when we do these capitalizations, the EBITDA and the EBIT stay the same. What do we assume about the money we borrow that allows us to keep operating income unchanged? Yeah. No, that is part of it, but there's something else we assume. That is true, we assume that, but there's something else because all this money coming in, how come it doesn't go into projects and create operating income?
You sell the equity, you buy back that.
In other words, whatever comes into the company, that's why it's called a recapitalization. I'm keeping the assets out of the balance sheet fixed. Yeah. So you're right, the indirect bankruptcy cost comes in the fact that if my rating drops, my EBIT will drop. The other is this assumption that I'm buying back stock or recapitalizing means that there's no cash floating around in the company. The company's assets are not changing, so the EBIT stays the same. The interest expense in the first round, remember there's a blank cell there. You don't know the interest rate. So the only rate you know is the interest rate at a 10% debt ratio, which was 8%. 8% of 300 is 240 million. You divide the 1 billion by 240 million, you come up with an interest coverage ratio of 4.17. This quiz actually gave you a lookup table. So if you go to the lookup table, 4.17 gives you a BBB rating and a default spread of 2%. Right now, their default spread is 1%. They're a AA rated company. Right now, they're AA rated. They're going to go to BBB rated. So the default spread goes from 1 to 2%. So my cost of debt goes from 8 to 9%. And I have a problem. The problem I have is I used an 8% interest rate to compute my interest expense, and now I'm telling you after I computed that interest expense that, hey, I made a mistake, it should really be 9%. That's why the extra column is there, because in the extra column, here's all I do. I take the 9% rate I've computed, 9% of 3,000 is 270 million, that pushes up my interest expense. My interest expense increases, my coverage ratio decreases. I turn to the lookup table and you will get a very quick test of how sadistic I am by what happens next. Because here you stay at BBB, you're done, but if I wanted to really be, mete out punishment, I would have you go to BB and then you'd have to do it again and again and again, and the game would never end. I wouldn't do that. And so if you're doing it multiple times, it's probably because you screwed up somewhere. It's not because I'm sadistic. You like inflicting pain on yourself. So just check your numbers. So that's at 9%. I'm done, because now the rating I give them gives me the interest rate that I use to compute my interest. That's your stopping point. So don't just say, I'm going to stop after 2 iterations. It's because your interest expense and your interest rate match up. That's your cost of debt at a 20% debt ratio. I think one of the saddest things about this problem is I think 80% of the people who did this problem got the cost of debt right, because the mechanics were, they just repeat. They were so engrossed, so engaged in getting the cost of debt right that they completely forgot about the cost of equity. So all they did was they took the cost of equity that they had at a 10% debt ratio and used it as the cost of equity at a 20% debt ratio. And you can't do that because you've doubled your debt, your beta has to change. So what you have to do is take the cost of equity you have and the beta you have, unlever it, and then re-lever it back up at the new debt ratio. So remember that any time your debt ratio changes, your cost of equity has to change. It can't stay frozen at what it was before. Otherwise, everybody would borrow money to get to 95% debt. So cost of capital here at a 20% debt ratio is 11.71%. Any questions on this mechanic? So if I did want to throw in a twist, it could be the indirect bankruptcy cost. And there I'd have to tell you, if your rating drops to some number, then this is what will happen. But I have to give you the specifics. You don't assume it if you don't have to. Yeah? Questions? Now, the second part of this problem, almost every single quiz 3, the second problem is a problem where you have a current cost of capital, the cost of capital changes, and then comes the part where you separate the people who actually get this problem from the people who don't, because then I say, what do you do next? It's usually a question about what will happen to the value of the firm and what will happen to stock price. So I'm going to take you through the mechanics of how to convert that change of cost of capital into a change in value. So the first step is you've got a cost of capital before, the old debt ratio, cost of capital after, the new debt ratio. First step is you've got to compute the change in terms of savings, how much you're going to save each year because you've lowered your cost of capital. So what I'm going to do is take the difference in the cost of capital and multiply it by the total value of the firm. Let me re-emphasize it, not by the market value of equity, not by the debt, by the total value of the firm, value of equity plus value of debt. So that's going to be my savings in 1 year. I've got to convert that 1 year savings into a present value, and there I have to make an assumption about future growth. If I assume no growth, the present value becomes very simple. It's a change each year divided by the cost of capital afterwards, because it's a savings for the firm with the change. And if there's growth, I take the change each year and divide by the difference between the cost of capital and the growth rate. So it's either a perpetuity or a growing perpetuity that converts the 1 year change into a change in value. That change in value is what's going to get apportioned between the people who sell their shares back and the people who stay in the company. So the first step is computing the change in value, but then comes the part of who gets what. So let's play a game, the same game we did when we went through this in class. You guys are going to sell your shares back, you guys are going to stay in the firm. The price I pick to buy back the shares is going to determine how much of the value goes to them and how much to you. If this were a fair game, and my definition of a fair game is everybody gets an equal share of the spoils, those who sell back and those who don't, my life just got very easy, because here's what I need to do. Take the change in firm value, divide by the total number of shares outstanding, including the shares that I buy back. Everybody gets an equal share. That's a fair price, because then the people who sell back get $8 per share, and the people who don't sell back also get $8 per share. Any other price is going to leave one group happy and the other group unhappy. Let's take the two extreme scenarios. Let's assume that I was able to buy the stock back at the old price. The people selling their shares back are completely indifferent to the fact that my value is going to go up. They sell back at the old price. So they get none of the increase in firm value because they sold at the old price. All of the firm value change then comes to you as the remaining stockholders. That's the most extreme scenario for you in terms of positive outcomes, that you're able to buy the shares back at the old price. Conversely, if I buy shares back at a really high price, you guys will benefit because you get a bigger share of the spoils, and you guys will walk away with a much smaller share of the spoils. In fact, if I pay a high enough price, you could end up with nothing. In fact, you could end up with negative numbers if I pay too high a price. So that's really how to think about the sharing of the spoils, is to think about the increase in firm value and who gets what. So I'm going to go back and take a very simple problem and then use this process to explain what will happen with different prices. This is a company you were given the market value of equity, 10 million shares trading at $25 per share, and debt outstanding of $50 million. Its cost of capital is currently 11%. It will drop to 10% if the company borrows $100 million and buys back stock. Buying back stock and paying dividends are equivalent in this world because they both lower the value of equity. Buying back shares reduces the value of equity by reducing the number of shares. Paying a dividend reduces the value of equity by reducing the stock price. The reason is very simple. On the ex-dividend day, the price will drop by the amount of the dividend. So in this case, it's $100 million to buy back stock. The question here was, what will the change in the stock price be if these savings not just last forever, but grow at 5% in perpetuity? So let's say, try this out. The total value of the firm is 250 plus 50, 300 million. Each year you're going to save about $3 million. It's a change in the cost of capital times the value of the firm. So notice I'm not multiplying by 250, I'm multiplying by 300. So the value of equity plus the value of debt. So that's how much you're going to save each year. If you're going to save that each year in perpetuity with a 5% growth rate, the growing perpetuity formula gives me an increase in value of 60 million. So I've got the change in value. I divided the 60 million by the 10 million shares outstanding, which is all shares outstanding. When I do that, I get a fair price. Why is it a fair price? Because if I pay that $6 more, $31 to you who sell your shares back, the people left in the company will also get exactly $6 per share. It's a $31 value for everybody in the company. And you can check that out. There's actually, in fact, with these problems, there's actually a way you can check your answer. And here's what you need to do. The value of the firm before the recap was 300 million. After the recap, it jumped to 360, right? It borrowed 150 million. So basically, you subtract out the 150 million in total debt, the old debt plus the new debt. You come up with 210 million. You divide that by the number of shares that will be left over after the buyback. The 10 million shares minus the 100 million new debt divided by 31. You come up with 6.774 million. You divide the value of equity by 6.774 million, you get exactly the same $31 that you got in the buyback. Everybody in this solution gets $31 per share. So if the problem does not specify what to assume about the buyback price, the safest price to assume, the price that will give you the least trouble, is to assume that everybody gets an equal share of the spoils, because then you can take the change in value and divide by the total number of shares, and that will give you the change in value per share. Yes?
The book value of the debt before the new debt is the same.
It stays the same. It's because it was market value. So basically it's 50 million, it stays at 50 million through.
That's good, because you have a new transaction now, so
Yeah.
your debt must be different value.
But remember, I mark up the interest rate. When I do the cost of debt, I mark up the interest rate and all your debt. So if you remember in the recapitalization, I didn't keep the old debt at the old interest rate. I actually allow you to mark it up to whatever the new interest rate is. So it's almost like you're marking up the debt, the interest rate on the debt to whatever the market interest rate is today. So that's why it stays at 50 million. If you did not do that, you'd actually be stealing from the old bondholders and you'd make yourself better off. So I'm preventing that by assuming that everything gets marked up to the new interest rate. Right? Any questions? Now let's try a different problem. Let's suppose a problem had said that the shares were going to be bought back at the old price. This is very convenient for the people who remain in the company. Let's see how the problem would have been different. The increase in value still stays 100, so the increase in value doesn't change, but now that increase in value will get divided up only among the remaining shareholders. So here's what I did. I computed how many shares you'd buy back with 100 million. At a $25 price, that's 4 million shares. That means there are 6 million shares left over after the buyback. 60 million divided by 6 gives you a $10 increase in price. So your price per share after the transaction will be 35. And that's why inherently this is an unfair transaction, because these guys get 35, you get 25. You got gypped, but you sold your shares back, so you can't blame yourself for getting gypped. In this case, that's an unfair transaction, but you get the bulk of the increase. So if I, in fact, wanted to test this out, here's how I do it. 360 minus 150, the 210 in value remains the same. I divide that by 6 million shares. Value per share is 35, exactly the value that I got with my calculation. Let's try one final. What if? What if I bought the shares back at $33.33? So I came and offered you $33.33. So each of you get $8.33 as a premium, right? So if I take the number of shares I buy back and multiply by 833, I get a total increase in value of 25 million. So I've given you guys 25 million out of the 60 million, which means you got only 35 million left over. I take that remaining 35 million, divide by the 7 million shares left over, you get $5 per share. So your value per share will be $30. And again, you have an unfair transaction. They get $33.33, you get $30. That's why the $31 is a fair price, because any other price, one group wins and the other group loses. And again, you can test it out. You should get the $30 per share using that process of divvying up the spoils between the people who sell the shares back and the people who stay in the company. So if you get a chance, take all the second problems on maybe the last 6 quizzes, set them next to each other. The problems can be structured differently, but they're all going to the same place because it's variants of the same thing. What's the change in value? Who gets what portion of that value? Because it's all about deciding who the winners and losers in this game are. Okay? Any questions? In fact, that's what I did on this page. As I said, the 60 million here, 25 million goes to people who sell their shares back. So that's another good way to check, is after you've got your numbers, work through the numbers and see if, in fact, the increase in value is being spread out across the two groups. Because if you get some other number by adding the two up, something's gone wrong again in the process. So you got the optimal, you got an actual. Part of the question might be, well, do you need to get to the optimal? If so, how quickly do you need to do it? So in a sense here, you're looking at what your choices are after you found your company to be under or over levered. So let me list out the 6 possible scenarios that can exist when you find your company to be mislevered. First, your company can be under levered and the target of a takeover. Why does it matter? If you're a target of a takeover, you don't have much time, so basically you've got to do something quickly. That's when you're going to borrow money, buy back stock, or borrow money and pay a special dividend, because when you borrow money, your debt goes up. When you buy stock or pay a dividend, your equity goes down. You can, in a sense, change your debt ratio in a day. If you're under-levered, you're not the target of a takeover, and you have good projects. So it's a trifecta. You have time, and you have good projects. This is a scenario where you should borrow money and take projects with that debt, because you have good projects that will increase your value even more. If you're under-levered, you're not the target of a takeover, and you don't have good projects. You have the luxury of time, but you don't have the luxury of projects. So here you use the time to either increase dividends or buy back stock over time and increase your debt ratio over time to get to your optimal. So when you're under-levered, what drives urgency is, are you the target of a takeover? And what you do after that will depend on whether you have good projects or not. So it's that section of the framework where we went through the under-levered firms with the luxury of time. Let's look at what if you're over-levered. There the question becomes, are you under threat of bankruptcy? So I might have to give you information to make that judgment, either the rating for the company or the fact that their interest expenses, they're having trouble making something to give you a sense of they've got to do something quickly. If they're over-levered, then you're going to have to do something quickly again. You either have to issue equity to retire debt, sell off assets to pay down debt, something to essentially bring your debt ratio down quickly. Not easy, but but has to be done. If you're over-levered, you're not under threat of bankruptcy, you have the luxury of time again. Again, I'm going to ask you, do you have good projects? If you have good projects, fund them primarily or predominantly with equity. Retained earnings, new stock, do whatever you need to do. Bring your equity up, and over time your debt ratio problem will go away. And if you're over-levered, you don't have good projects, and you have the luxury of time, then again you've got to do the slow motion adjustment. If you're paying dividends, stop. If you can raise equity over time, try. If you can use retained earnings to pay down debt, do so. Anything to bring your debt ratio down over time. Any questions on what to do after you're under-levered or over-levered? Yes?
So on the quiz, would you present the condition and then have us take that?
I might give you info. That's actually a good question. I'm not going to tell you the company has good projects. I'm not going to say the company is the target of a takeover. So I'll have to give you clues, right? So do you remember what the clues were for whether a company is the target of a takeover? What are the 3 things that will tell you companies what's a trifecta that makes you a target of a takeover? First, you're under-levered to begin with, so small or mid-cap company. So if I tell you your company is a $350 billion company, already you're going to say, well, that's a strike against. The second is whether they have substantial insider holdings, right? If there is 35-40% held by the managers, that's going to, or if they're voting shares and non-voting shares, something about corporate governance. And third is Jensen's alpha, or something to measure how well or badly they're being. So here's the trifecta. If you're a small to mid-cap company, no insider holdings, and the Jensen's alpha is minus 40%, the crumbs can't be lined up any further for you. That company is the target of a takeover. If it's a $350 billion company with 2 classes of shares and its Jensen's alpha is plus 55%, now, so I will have to make it extreme enough that you don't have it. So I'd probably give you all 3 to make sure that at least 2 of the 3 register. So if it's under-levered, those are the clues you get. If it's over-levered, the clues I'll have to give you will have to relate to either bond ratings and say this company is rated CCC. You don't have to say, is this company safe? If it's CCC, it's not safe. Or that its interest coverage ratio is 0.53, which means it's having trouble making its interest expenses. You then know it's under threat of bankruptcy. For the good project, bad project, I'm going to give you some information on what it's done in the past. I'm going to say return on capital in the last 20 years, or the last 10 years, or the last 5 years is 3%, the cost of capital is 11%. That's it, you've got bad projects. Again, I have to give you enough clues that you can make that judgment. But that's what you should expect to see when you see these prompts. Any other questions? I know this regression part came and went in a haze, so I'm going to summarize what we did in that class on one page. I ran 4 sets of macro regressions, and I'll give you the justification for each one and how to read each one. First, I regress change in value against changes in the T-bond rate. And I said the coefficient B on that regression, so that's the very first regression, tells you something about the duration of your assets. So if you run this regression and you see a coefficient of -5, I said you can read it as, roughly speaking, duration of 5 years, that your company has assets with an average duration of 5 years. So the interest rate regression tells you something about duration, but only the coefficient is negative. If it's 0 or positive, just let it go. It might not be telling you anything at all about the duration of the assets. But if it's negative, take out the sign. That will give you the duration of the assets. The second regression I ran was firm value and operating income against GDP. What does that tell you? If the coefficient on GDP is a big positive number, it means your company is a very cyclical company. If that number is 0, your company is a non-cyclical company. If that number is negative, your company is a counter-cyclical company. Again, you've got to bring it as best as you can into your debt design. Then I ran the regression against inflation. If the coefficient of inflation is a big positive number, that big, then your company has pricing power. You're saying, so what? If it has pricing power, it's a much better candidate for floating rate debt. But if that coefficient is 0 or negative, it doesn't have pricing power, you're a much better candidate for fixed rate debt. And lastly, I ran a regression against the weighted dollar. If that coefficient is a big positive number, it means a stronger dollar helps you. If it's a big negative number, a stronger dollar hurts you. Either of those conditions means you've got to get some foreign exchange protection. Because if you're hurt or helped, it doesn't matter. Either way, you've got to get some protection. So look for the coefficient. If that coefficient is close to 0, then you're unaffected by exchange rates. You could get away with just all US dollar debt if need be, because it doesn't seem to affect you. So I think there are a couple of quizzes where I've given you all 4 regressions and asked you to design the right debt for the company. It's really a question of reading each coefficient and say, what does this tell me about my company? Right? And the last problem on almost 80% of the quizzes is actually a problem that looks very much like the problem, the third problem from your first quiz. With that bottom-up beta problem, that kind of bizarre combinations of things happening and ask you what will the beta be after an acquisition, divestiture. These problems are almost exact replicas because the same principles apply. Just like betas are always weighted averages, durations are always weighted averages. The duration of your assets is a weighted average of the durations of the individual assets weighted by their market value. The duration of your debt is a weighted average of the different debt issues they have weighted by their market values. So almost every one of these problems, I'll give you something about the asset side, something about the liability side. And almost every problem, I'm asking you something about the duration of the debt you need to issue to get back to steady state. So I'll give you an easy version of the problem from a couple of quizzes ago, and then I'll give you a tougher version of the problem. Here's the easy version of the problem. In this problem, I actually gave you the regression equation for the company. I said I ran a regression of changes in firm value against changes in interest rates. Remind me again, what does that coefficient tell me? I take the -5, I take out the sign, that means the duration of my assets is roughly 5 years. Okay, so I've got the duration of my assets. Then I said the firm is 100 million in 0 coupon notes. I'm very fond of 0 coupon bonds in this problem. You know why? Because of the 0 coupon bond, when I give you the maturity of the 0 coupon bond, I've also given you the duration. If I give you any other bond, I have to give you the duration separately. Because if I say it's a 5-year maturity bond and it's got regular coupons, the duration will not be 5. So because it's a 0 coupon note, that 2-year maturity is also the duration. So they've got 100 million in debt with a 2-year duration. They're planning to borrow another 150 million using other 0 coupon notes. And the question is, what would the maturity of that second issue have to be for this company's duration of its assets to be equal to the duration of its debt? So let's start with the easy part. The duration of the assets is 5 years, right? I want the duration of my debt to be 5 years. Remember I said these are weighted averages. You got 100 million in old debt with a 2-year duration, 150 million in new debt with a duration I don't know. It's a simple algebra problem. You solve for x, you get a duration of 7 years. These problems again, just plug it back. Make sure you got the right answer, because if you plug it back, you should end. So both this problem and the second problem, you can check your answers by just plugging back the numbers to make sure your answer is in fact the right answer. So this problem is easy as long as you read the regression. If you didn't read the regression, then you said, where are the duration of the assets? You didn't give it to me. But to the extent that you read the regression, you could use it. Now comes the messier problem. So in this company, the problem looks almost, this is the year following that previous problem. So everybody read the first part and said, he asked the same problem again, because it looks almost exactly like the same problem. I said, there's the regression. So the duration of the existing assets is 7.5 years. Then I said, the company has two types of debt outstanding, a $200 million bond issue with a duration of 1 year and a $100 million bank loan with a duration of 4 years. So I've actually given you the duration here. And it's got 70 million shares outstanding, trading at $10 a share. You're saying, why do you give us the share price? You're going to see in a minute why you need the share price. Okay? They're going to borrow $250 million to buy a new business, online retailing. And the duration in that business is really short term. It's only 1 year. So what should the duration of the debt be for this borrowing, so that they end up with the duration of the debt equal to the duration of the assets after the acquisition? So first step in this problem, just like in the beta problems, is always work with the asset side of the balance sheet. Remember the beta problems, we always did the unlevered beta first before we did the levered beta. I'm going to do the duration of the assets first before I do the duration of the liabilities. So what's their existing assets? The duration of their existing assets, 7.5 years, right? What's the value of their existing assets? Now do you see why I gave you the market cap? The value of their existing assets is 700 million plus 300 million. 700 million in equity plus 300 million in debt. They have $1 billion in existing assets. The value of the new asset is going to be 250 million. The duration of the assets after the merger is going to be a weighted average of what they had before, weighted by $1 billion, 7.5 weighted by $1 billion, and 1 weighted by 250. The duration of my assets after the merger will be 6.2 years. And then in the second part of the problem, all you have to do is solve for the debt. You're going to issue 250 million debt, what the duration of that debt has to be to get to 6.2 years. Always do the duration of the assets first. Once you get the duration of the assets, then turn your attention to the debt and say, what am I trying to solve for? And then solve for the duration of that debt. Yes, Michelle? Yeah.
You're expanding into a different type of business. So why is it relevant to use the 7.5? Like, shouldn't you just say that?
But I'm not matching up the duration of just the new business. I want the duration of the whole company to be matched up afterwards, right?
Match up the assets, the new assets of
If,
the business with
okay, let's try that. If I issued debt then with the duration of 1 year, and I plugged in the 1 year in here, I'll actually end up with a duration. What they have right now is mismatched debt. Your solution would work if their debt right now were matched up. But right now, here's what they have. They have a 7.5 year duration on their assets, but their existing debt has a weighted average duration of only about 2.5 years. So what you're making up for is the fact that their existing assets are mismatched and you're using the new debt to kind of get back. But if you are already at steady state, you're absolutely right. All you have to do is match up the new assets. But if you're not, then you've got to use it to kind of cover that difference as well. Okay? So try these problems. Actually, once you work through 3 or 4, you're going to recognize how similar they are to the beta problems in terms of how you approach them and the techniques you use. And there are only so many variants I can throw at you. Acquisitions, I can throw in a divestiture. I can use the divestiture to pay off the debt and say how much of the debt would I need to pay off and which type to get my duration back. But it all boils down to doing it sequentially. Duration of assets first and then duration of debt. Any questions? Yes?
You assumed in your example that the current duration of the is the coefficient that was.
Mm-hmm.
What happens if you get like more than one regression?
What if you're in more than one business?
Yeah, or if you write regressions for multiple variables.
Then you can't read them. That's why I didn't run a multiple regression. Multiple regression, because of the correlation between the variables, is almost unreadable.
So you
No.
wouldn't provide us that you only get one coefficient.
If I did, I wouldn't know the solution, and that's not a good place to be when you write a quiz. So it'll always be a simple regression. Because once you get past the simple regression, you're going to have all kinds of statistical issues kind of bubbling up. Right? Okay, so I'll see you tomorrow.
I don't think for now that it's an allocation, but it's a deciding factor of your plan.
Right, I'm just trying to isolate three levels later, and you account for the impact of the debt. You're only accounting for the debt to equity ratio and nothing related to the coupon. As far as the risk to cash. Right, but I'm just thinking interest expense reduces the net income available to equity holders, but you just wouldn't want to account for that in your revenue because you're already including that in the cost of debt.
I mean, that's what happened when you borrow money and buy back shares, because your net income will decrease, but so will the number of shares. That's why we never look at net income. Net income can be a number that doesn't tell you much about whether debt is good or bad, because the net income will always decrease when you borrow money and buy back shares.
Yeah.
But that's fine, because it's fewer shares. It's earnings per share that we look at when we think about what we pay for a stock. So the interest expense is a side story. Once you get past the tax benefits, it doesn't really matter. We're talking about a different company in terms of number of shares outstanding.
Yeah, I emailed you before about the two questions with the buybacks.
Yeah.
In one, you were taking a look at the difference between what your prior cost of capital was and then your new cost of capital. You were multiplying that by the old firm value, and then you were getting a value there, and then you were comparing it to the amount that you were paying as a premium to the buyback, and then the difference was whether and the difference over the shares outstanding was the positive or negative effect, right? And that was looked at as that was the premium amount you're paying. But in a different problem, when we were talking about buybacks, you were looking at the premium paid over the.
This is working the other direction, right? So basically, what happens is a change in value becomes a premium paid to the remaining shareholders and a premium and whatever the remaining. So if I gave you what I paid as a buyback price.
Uh-huh.
And I also told you what the price of the remaining shares was after the buyback.
Mm-hmm.
Because it's the same firm value. You know, in one sense, I'm computing the firm value, in the other, I'm looking at how the firm value is distributed. I can give you either side of this
Okay.
process. So depending on the problem, which one I'm giving,
Okay.
you're working either from what I paid
Yeah.
and what you're left with to the firm value, or you're computing the firm value change.
Okay.
It's not different ways. It's
Yeah.
just coming to the same number from two
Yeah,
different
I'm
directions.
trying. Yeah, I try to go about it. The one problem using
You
the
can't.
difference.
The problem you want me to, if I give you the other side of the equation, I'm not going to give you the cost of capital. The problem will ask you for something different, right?
Yeah, no. But I'm saying I tried to do it after I solved it the other way,
Right.
and then I tried to take the differences in what the new cost of capital was between the old one, and then multiply it by the old firm value, and then calculate the premium on shares based on that. Yeah, I didn't.
Send me a calculation. I'll take a look at it.
Okay.
You should get it.
Okay.
Two
Yeah.
questions. One is you had that equation up here earlier. If you calculate the increase in firm value due to the new funding, you calculate the cost of that capital or the difference in cost of capital times the old firm. Why are you keeping the old firm?
Because that's what you can save. The savings don't apply. The new, so let's say that you had $800 million in old firm value. That was funded at 10%.
Right.
You now move to 9%. You get the savings of going from 10 to 9 on the 800 million. Any increase in firm value is never funded at the old cost of capital.
Right.
So you can't tell me your so let's say that you tell me your value is going to go from 800 to 900 million. That extra 100 million you create in value was never funded at the old cost of capital. You can't tell me there's savings on money that was not even
So
there.
you're saying the new cost of capital is due to the savings?
Exactly.
Okay. I think that's what I have wrong. The other one is regarding the project. I chose a company which I'm comfortable with. It's Bombardier, which I take you an expert in anyway.
I'm not an expert,
But yeah, only after I chose it, I heard you had a project on that. Is the thing reviewing the first slides you had about them? You said we shouldn't take money losing companies,
Right.
or they are losing money for the last 2 years due to this investment in the development of new planes. Would you say that disqualifies Bombardier?
It will make it messy. It will make it messier because if you use what they're actually making, they can't afford to borrow money. They
Right.
can't afford to pay dividends.
Right.
So if you're going to use them, you have to figure out a way to normalize those numbers and say they're going to go back to some reasonable profit level.
Mm-hmm.
Now, how you do that is up to you. So you might
Right.
look at margins over the last 10 years and say that's what a typical operating income is. But you're really dancing on the edge because Bombardier is not losing money because they're developing new planes. They're losing money because they borrowed a ton of money and they're in a business where it's a very competitive business. They've
It
lost sales and it's a business where their being in trouble is hurting them and they're competing in some Embraer or Airbus. So they're actually in a spiral which they have to get out of, which is very difficult to do when you're a B-rated company
Mm-hmm.
and everybody's concerned that you might not make it.
Right.
The only reason I think they're okay is because people feel that the Canadian government will step in and provide some kind of support because it's the only Canadian aerospace company. The feeling is the Canadian government is not going to let them go.
Right.
So it's a mixture of issues. They're a family control company
Yeah.
with a lot of issues in how they're run. And the question you've got to ask is, what would they make in a regular year? So let's assume the last 2 years were an aberration. Something was going on, and you think that once they pass, they can get back to something reasonable. You have to figure out what that operating income will be, and use that operating income to come up with your optimal debt ratio.
Right. Interestingly, looking at the 10K, they have an EBIT without those special effects, and that is positive.
Okay, you can use that then.
Okay.
Just use because even that is a low number.
Yeah.
It's you're not going to get much debt capacity even with that. It's been positive, but it's barely positive.
Right.
You know.
Right.
So you might have to go further than that. You'll have to ask not just is my EBIT, what's my EBIT before the extraordinary items? You might have to ask what would it be if they were in a